Thank you very much. Welcome everyone to Consensus 2019. One second. My name is Alex Sunnarborg, and today I'm going to be presenting to you the state of blockchain. Now this is a presentation I really like. 2 years ago when I was working at CoinDesk in research, I actually gave this presentation. Today I've since started a hedge fund, so I'm inherently a lot more biased. But I prepared this presentation in the spirit of objective research. I'd like to give an overview of the full industry. So obviously when you look at the name, the state of blockchain, this is meant to be an industry overview report. So nowadays, not only do we have Bitcoin, the first and original blockchain, which just celebrated its 10th birthday, the original vision of a peer-to-peer electronic digital cash system, but we also now have the hundreds of other blockchains that have since been launched and are yet to launch. So before I dive in, I wanted to set the stage really fast of how I generally separate these. I generally think of our core base layer blockchains in two distinct categories. One that are trying to be sort of the next generations of money, your stores of value and your currencies, things like Bitcoin. The other distinct category I view as these decentralized application platforms, trying to build out this Web 3.0 or this new version of applications run and distributed by the community. This is in contrast to these tokens that were created following a lot of these dApp platforms, actually created with these smart contracts and launched upon these other base level blockchains. So importantly, a lot of these tokens do not have their own blockchains and rather rely to some extent on the dApp platforms that they're hosted on. And as well as these liquid tokens, the industry has grown quite large at this point. We have over $5 billion invested through the years into all major sectors, including wallets, exchanges, miners, etc. So let's talk about what we really learned from this last cycle after we have an idea of what the entire industry looks like. So in 2017, when I gave this presentation, Bitcoin was at about a $16 billion market cap. The next year, Bitcoin rallied about 20x to just over 300 billion. But this was actually very outperformed by the altcoin sector. Lots of these altcoins actually did 100x plus. Liquidity is something we'll dive into, so maybe it's not quite as realizable as possible. But nonetheless, in 2017, we saw a massive bull run where smart contracts, forks, the better Bitcoin, just generally euphoria and speculation took us to heights we've never seen. And in 2018, we saw that a lot of these altcoins were essentially just higher beta assets to Bitcoin as they dramatically underperformed and came unwinding down, seeing the Bitcoin dominance ratio rise to over 50% by the end of the year. So let's dive into liquidity, as I was talking about. We recently learned quite a bit about the liquidity of the overall market in this last quarter. But taking us back, the liquidity in the crypto space has always been kind of questionable. So prior to 2014, most trading was either done peer-to-peer off of internet forums or on the biggest original exchange, Mt. Gox, which took up nearly the entire composition of trading until 2014 when it was hacked for about 850,000 Bitcoins. Trading volume took quite a bit to recover before we saw this very large spike of Bitcoin trading in 2016 and 17. This was actually due to these three big China, quote unquote, big three Chinese exchanges, BTC China, OKCoin, and Huobi, who posted volume levels we'd never seen before. At the end of 2016, though, actually all three of these were investigated by the People's Bank of China around their operations, and we saw trading volumes dramatically fall off, leading us to assume there was something questionable going on. So although Bitcoin volumes fell off, the price rise in 2017 and 18 actually led trading volumes overall to look quite good looking back. And nowadays we have a more diverse distributed set of exchanges than ever before. But what we really learned recently was this report put out by Bitwise, an asset manager that's been trying to get an ETF approved. When they looked in Q1 at the reported volume on CoinMarketCap, they saw over $6 billion of reported Bitcoin trading volume. When they actually looked into the order books and sort of filtered out what they thought was more legitimate versus fake volumes, their conclusion was that less than 5% was real, and that only 10 out of the 81 exchanges they looked at had real, actual volume. I will point out the top two, Binance and Bitfinex, and several others in this list at this point have actually been hacked as well. So that's just today what it is, I guess, in the exchange landscape. Another very interesting thing we learned is how big the derivatives market is compared to the actual spot market. When we look down to the $273 million of spot volume that was actually traded in those times, we can see that futures volume is about nearly half of it. That's mostly comprised of the CME, which after launching in December 2017 has actually seen quite an uptick of volume to today. One thing that was not covered in the Bitwise report, which I really wanted to point out as sort of the dark horse of volume, is BitMEX. This is a Hong Kong-based platform that trades a Bitcoin USD perpetual swap, which just yesterday reported over $10 billion of volume. This is over, as they quote on their site, 15 times more liquid than any spot market for Bitcoin. I would also say that recently we've seen a growth in other derivatives platforms, including LedgerX, including Deribit, and just in general, what I just gave you is an overview of the Bitcoin spot market. Altcoin volumes are generally even less liquid than that. And I would say, generally, although exchange volumes remain somewhat questionable, at this point, everyone's on the same page, and it's really about just being transparent and having everyone aware of really where all the trading is going on. That's the most important. I would say another thing with these derivatives markets is it not only added to the liquidity of the space, but it also very much contributed to the price discovery, as a lot of these tools and products allowed traders to go short and really express their opinions on this wide range of assets. So let's jump into what we learned about valuation during this period. Now, in 2017, we saw this humongous rise in ICO volume, back when regulation was pretty light. A lot of people at the time in Q1 2017 were extremely frustrated with Bitcoin. A lot of this had to do with the fact that transaction fees were increasing over $1 and all the way up to near $50 towards the end of the year, as well as people were just extremely excited about Ethereum, smart contracts, tokenizing everything, and there's just this massive euphoria to decentralize the web. And that led us to this massive bubble, wherein a lot of these ICOs took in Ether, locked up these funds, and then several of these ICOs even reinvested into other projects. And this essentially just led up to this bubble of a lot of locked up ICO token and Ether supply, leading to a massive spike in price before the thing came unwinding down. And essentially in the bear market that quickly followed, all of a sudden, there was massive euphoria and interest on the way up through 2017, but in 2018, really interest just fell off a cliff. Google search interest fell to lows that we'd seen back in 2017 before Bitcoin went on the massive price rally. Ethereum dApps globally never saw one period where over 50,000 unique users used a dApp in a single given day. Obviously, these apps were created to sort of decentralize the web and bring massive users in. And there's no billions or millions of users on these dApps. There's tens of thousands to thousands to even less. So during that time, a lot of these ICOs that had actually raised ETH started to sell it back onto the market. And this sort of bearish selling just completely unraveled the Ethereum price. At the same time, a lot of these companies during the bear market were forced to project for the worst. As their revenue models had not met their expectations, they were forced to go into layoffs to try and extend runway to as long as possible. Generally, while depression was pretty low in the bear market, we also saw the rise of a few other platforms that came to launch, notably EOS and Tron. Now, when we were looking at transaction numbers, what many people thought were a core sort of KPI or key performance indicator for the space, these two blockchains caused the industry to sort of question what's really important. We saw both of these platforms exceed over 1 million transactions per day. When you look into the data, you can see that a lot of these transactions were on both gambling and gaming type of applications. Another interesting thing about EOS and Tron is that end users pay no transaction fees. So when you're comparing across to something like Bitcoin or Ethereum, which with a much lower throughput and much lower transaction fees, came to have people realizing, is high velocity even a good thing? Are these dApps sort of the very important use cases that we want these to be attacking? And does a huge spike in transaction count really, is that even a bullish signal? Or is it maybe indicative that there's some sort of centralization issue with actually who's sort of producing and approving these blocks? And really in crypto, it sort of took us back to really what's important here. If blockchains really are security systems, and Bitcoin's trying to be this store of value, really we should adopt maybe more of a security maximalism type of perspective and really start to see, if what's important for something like a store of value, is it decentralization, the monetary policy, the fungibility, et cetera. And if we were to sort of tweak some of these inputs, to cause advantages in the other sectors. Really, what do we lose as a trade-off? And in general, in the bear market, there's a lot of criticality in thinking about just generally how do we value these assets? What's the target addressable market? How do we think about velocity in any sort of equation? For Bitcoin, I'd say it's relatively straightforward. It's trying to be a store of value asset. It doesn't need to be traded. This thing needs to be held. Generally, the store of value market is multiples and multiples times larger than Bitcoin is today. And if some of these altcoins are going to try and compete with Bitcoin, it becomes a question of, is the store of value market a winner-take-all or winner-take-almost-all market? And how much will some of these assets be able to take market share from Bitcoin? And the other large question of, if it's not a store of value asset, really what sort of valuation multiple can you, or valuation model can you use to value this thing? And how does its value stack up? And generally in the bear market, everyone was looking, what will the Bitcoin dominance ratio do from here? Is Bitcoin going to take over as this dominant store of value asset? Are additional assets going to keep getting developed? And how are we going to value them? And sort of in the bear market, when everyone is as critical as possible, this is sort of the time where depression's highest and really about the time that everyone's looking for, okay, when is this market going to start bottoming? There's still thousands of people coming to consensus. We're all at least very bullish in a piece of this asset class. So signals we started looking for. From the peak, Bitcoin came down over 85%. This is a really dramatic, 15-month type of move. But since December, Bitcoin's actually went up over 85%. We've actually gained more since the bottom at this point than we lost from the peak. And one thing is very important to keep in mind. This is a recent price chart. Obviously, there's strong momentum here. Additionally, though, this momentum happened post-April at the same time that major, quote-unquote, bad news came out. The New York Attorney General looked into Bitfinex at this time. Binance got hacked for $40 million about a week after. We've seen basically no negative price movement there. If anything, just sort of long-term bulls using it as an opportunity to sort of buy this dip. Generally, when you look back to the last cycle too, this price chart just looks eerily similar. So this is the 2013 and 14 and 15 cycle compared to today. You can see this obvious accumulation zone whereby it visually looks quite like the last cycle. And right afterwards, this 2015 rally turned into the 1,000 to 20,000 bubble that we saw. In addition to sort of pure price and TA type of metrics, a lot of firms came out with research looking at the sort of on-chain metrics, so the Bitcoin UTXOs. Actually, in late November, we saw the largest number of Bitcoin days destroyed ever, which is generally a formula using the size of Bitcoins moved and being greater days destroyed if it's an older holder. So essentially what we're looking for here is signs of capitulation. When are the last sellers actually selling their coins before buyers step in? And when we look at the bottom to this chart by Delphi Digital, we can see that the sort of UTXOs from long-term holders became to look very similar to the 2015 type of rally. And in general, one of the largest events on the Bitcoin roadmap is the upcoming halving. That's now just about a year away. At this point, 7/8 of all the Bitcoin that will have ever been mined are going to be mined at that point. So the incoming scarcity functions as a massive catalyst for inflows. Additionally, on finding this capitulation point, in November at this last final price fall, we also saw a large drop in hash rate, presumably as miners turned their machines off in order to also save expenses and potentially bear for the worst. Since, we've seen hash rate come around and it's nearly at an all-time high yet again, proving that perhaps we have bottomed, miners are back on, all miners that capitulated and have sold the coins have done so, and Bitcoin's back to securing this network. And the ratio right now is actually near a all-time high. Generally, when we're looking at the transactional infrastructure of Bitcoin too, in August 2017, segregated witness was approved, and nowadays we've seen nearly 50% of all Bitcoin transactions using SegWit. This has actually helped with the Lightning Network rollout as well, which in the last 6 months we've seen gone from nearly zero to now several $1 million of capacity. In Q1, I think it was also quite exciting to see the Lightning torch being passed around, really bringing the light to Bitcoin and layer 2 payments. And on this note, again, stemming from SegWit, we saw Peter Woolley's Taproot proposal recently come out, which will further enhance sort of Bitcoin scalability and privacy, similar to Lightning. And in general, looking at all these blockchains, things like SegWit, has generally led us now to, fees are back down. Fees are no longer $50. They're generally under $1 on every chain. And transactions are generally up. So I see this as fairly bullish. One other sort of metric and big theme lately is this DeFi, this decentralized finance. So one of the biggest projects in this DeFi space is Maker, which actually is an Ethereum project that lets you lock up Ether as collateral in exchange for a stablecoin type of loan. This is actually locked up over 2% of all Ether at this point. And I would say in general, it's a sign of the market being risk on. Although it does have its UX issues like most other apps, right now it costs almost 20% to close out one of these loans, and these loans are collateralized almost 450%, saying something about the market's sort of faith about the underlying collateral. But in general, I would view this as a growing theme, something that developers are building, something that people are using, and definitely a sign of risk on, as a lot of these loans are then being re-levered or invested back into Ethereum or the ecosystem. Another big trend that I've seen that also says similarly is this growth of the staking market. So at this point, there's over 20 assets I have here that are live with some sort of staking system allowing investors to earn some sort of passive yield. One caveat I would point to is the fact that there's very low liquidity on a lot of these platforms. Some of them require you to stake a large amount of capital up at once. And et cetera. AKA there's caveats, but this is another sign that the ecosystem is getting more diverse and people are actually allocating and being risk on to areas. So one trend during 2018 when ICO volume came down dramatically was we actually saw a huge uptick in VC volume. As these ICO tokens were losing money rapidly and their valuations were being bid up, a lot of capital was invested into VC. This reminds me quite a lot of 2014 and 15, when a lot of capital was invested into sort of the infrastructural type of exchanges and wallets that brought us through the 2017 bull market. One also interesting risk-on trend, I would say, is in 2019 especially, we've seen a dramatic rise in this IEO, or initial exchange offering, wherein exchanges are getting in the middle of this new token issuance process. And in general, one of the biggest bullish things is just talent continues to pour into this space. Throughout 2018, even with declining prices, people continued to go to work towards blockchain. People coming out of leading institutions are going towards blockchain. Blockchain developer was 2018's top emerging job by a mile. And nowadays, people are working in blockchain at not just the crypto companies that I'm familiar with, but Facebook has efforts. JP Morgan is developing a stable coin or similar. HTC is looking to put wallets into their phones. The amount of companies that are really involved in building out blockchain is truly more than ever before right now. And one thing we've been long talking about is institutions entering. And surprisingly, it seems some of them actually did sneak in during the last bull market. Fidelity recently did a survey with over 400 institutional investors during the height of the bear market in Q4 2018 and found that over a fifth of them had already had exposure to digital assets. On top of that, about 2/5 looked like they would have exposure sometime soon. And probably the craziest statistic is this survey done at a similar timing with endowments. Over 94% of the 150 endowments that were surveyed had already had exposure to crypto, about half through funds and half direct. These endowments include some of the biggest brands and names in the space, including all these Ivy League schools I have laid out here. On top of that, pension funds have also invested into crypto, into funds now. This is really long-term capital, and the signaling here cannot be understated. Of those that have not invested into crypto, custody remains a top issue, and the custody offerings have dramatically expanded from 2017. Now in 2019, the amount of regulated and insured products is at an all-time high, and sort of custody and trading solutions like Bakkt's recent acquisition of DACC and Fidelity's upcoming offering will only bring further inflows into the space. As the SEC continues to shine regulatory clarity on what is and isn't a security, it seems obvious to me that they're very enthused about innovation in the space, and they're just simply concerned about investor protection. And another big thing we've been thinking about forever is this ETF that the Winklevosses initially submitted an approval application for about 6 years ago. We seem to be getting closer than ever, and just as one sort of comp, I would say that the gold ETF got over $1 billion in inflows during its first week on the market. So the potential new amount of money that could come in with a product like this being approved is quite significant. So in summary, I think in 2019, the state of the market today is everybody's just been thinking for the past quarter about, has the bull market truly ended? Is this the start of the next bull market? And I can say at an absolute minimum, the state of developers and the technology is higher than ever. Researchers and investors are being more critical than ever. We have real long-term institutional capital actually invested right now. The infrastructure is more mature than ever. And truly, I could not be more excited to be working in blockchain at any other time than today. So thank you very much, everyone. That was my rendition of the state of blockchain. And I hope to hear a lot of exciting announcements today. Thank you.